There's a really big hurdle or obstacle when it comes to buying or selling condos right now, and it has to do with insurance. So insurance has a master insurance policy for that condo community for the exterior and common places of that condo association. Well, when it comes to the master insurance policy, there's basically two types of coverages that are had. It's either actual cash value or replacement cost value. So let's break that down. Replacement cost will replace something at the actual cost to replace it. Let's say a lightning strike hits a building and it's $100,000 to replace that roof. If you have replacement cost value on that building as a master insurance policy, that $100,000 after that deductible is covered in full. If that condo association has actual cash value, the insurance company is going to say, that roof is 10 years old, we've got to depreciate it, it's only really worth $25,000. They'll give you $25,000. Who pays that $75,000 difference for the actual cost? It would fall, unfortunately, on the homeowners of those condo units. So Fannie Mae and Freddie Mac, who make up all the rules for conventional loans, most of the loans that are done through banks, lenders, and brokers, they're the ones that say actual cash value, we won't accept it. And it's becoming a really big problem, and here's why. A lot of insurance companies are requiring newer roofs on condos, on those buildings. And a lot of condo associations had said, well, we have an estimated life of 20 years on this roof. Our roofs are only 14 years old. So we're going to start collecting and putting money aside towards it, but we have 6 years until we have to replace those. A lot of insurance companies are coming back saying, we don't love any roofs older than 12 years old. They're weathered, they're out of current code, and they're just not holding up the way that we need them to. So think about this. If a roof gets ripped off of a home or a building, basically everything inside it is destroyed through a tornado, a hurricane, a storm, something along those lines. So if it's newer, usually it can withstand some things a little bit better and stronger because it's to current code and has all the things that they are looking for. So a lot of insurance companies are now saying, hey, it's time to renew your annual policy, but we can't do it at replacement cost value unless you replace those roofs. Well, it's not in the budget for a couple more years, right? So we can only give you actual cash value. Fannie and Freddie won't allow it. So what does that do then? That means you cannot get a conventional loan on that property as a buyer, and then sellers can't have a really wide open buyer pool because it's really only going to be limited to people with cash or that can afford what's called a non-conforming loan. So what does that mean? There are some lenders that will allow the ACV type of insurance, but they typically require 20% down, and it's usually at a higher interest rate or higher costs to obtain this loan because of the risk. It's not backed by Fannie or Freddie, and therefore it's not a conventional standard mortgage. So keep that in the back of your mind if you are considering listing or buying, or representing a seller or buyer, and just know that that is becoming a really big obstacle. The secondary obstacle is not having proper reserves. So as these annual contracts are coming up for renewal, for insurance, for landscaping, for pool supply, all of those things, costs have gone up radically across the board for most services, most products, most anything these days. And so as those annual contracts are getting renewed at a higher cost, there's one of two things to do. You increase the monthly HOA dues or condo association dues for all of the owners, or you tap into your reserves until you don't have any reserves left, which is savings. It's really important. But one of the things that is a requirement of Fannie and Freddie Mac, if you're buying a home with a conventional loan, is they like to see 10% in reserves necessary for approval. The only way to get around this is if you have a 25% down payment. They don't look at the budget and they don't look at the reserves. So there is a workaround with this. Unfortunately, there's not a workaround with the insurance obstacle. So make sure you know this as you are talking to people when it comes to condos.